The Age of Debt Bubbles, authored by Max Rangeley and a collective of economists and financial experts, examines the underlying dynamics of global finance in the 21st century, with a particular focus on how modern monetary systems, driven by debt, influence economic cycles. The central thesis of the book is that the modern economy is fundamentally shaped by the creation of debt and credit, and that this process, particularly the formation of debt bubbles, plays a critical role in both fostering periods of economic growth and precipitating financial crises. The book begins by exploring the history of money and credit, tracing their evolution from traditional forms of exchange to the complex financial systems we have today. It delves into the mechanics of how money is created in contemporary economies, particularly through fractional reserve banking, where commercial banks lend more money than they hold in reserves, effectively creating new money. This process, while fueling economic growth in the short term, is also a precursor to debt accumulation, which eventually leads to the formation of economic bubbles. Throughout the book, the authors argue that the cycle of debt creation and busts is a fundamental feature of modern economies. The initial phase of borrowing stimulates investment, spurring economic activity, while the increased availability of credit allows for the expansion of asset prices, including real estate and stocks. However, as debt levels continue to grow unchecked, the risk of financial instability rises. When the debt burden becomes unsustainable or when interest rates rise, these bubbles burst, leading to recessions, market crashes, and, at times, depressions. One of the core insights of the book is the relationship between debt and central banking. The authors emphasize the role of central banks in managing economic growth and inflation, particularly through their control over interest rates and monetary policy. By lowering interest rates and providing easy credit, central banks encourage borrowing and investment, which can help stimulate economic activity during downturns. However, when central banks engage in these practices over extended periods, they inadvertently fuel the creation of debt bubbles, making economies increasingly reliant on cheap credit to maintain growth. The book also critiques the actions of policymakers who, in their efforts to maintain economic stability, often exacerbate the problems of debt. The authors argue that central banks and governments, in their pursuit of short-term economic growth, have failed to address the long-term consequences of debt accumulation. Their policies, such as quantitative easing and low interest rates, are seen as temporary solutions that only delay the inevitable reckoning of a debt bubble bursting. These policies, according to the authors, have led to a systemic reliance on debt, creating a fragile economic system that is prone to frequent cycles of boom and bust. One of the key discussions in the book is the impact of debt bubbles on ordinary citizens and small businesses. As the financial system becomes more leveraged, wealth becomes increasingly concentrated in the hands of a few large institutions and individuals. This growing inequality, fueled by the pursuit of speculative investments and the rising costs of debt servicing, undermines the purchasing power of the middle and working classes. The authors argue that this growing divide is not only a social issue but a significant economic one, as it creates a system where wealth is disproportionately accumulated by those at the top, leaving the broader population vulnerable to the instability caused by debt bubbles. The authors also propose that in order to break free from this cycle, a fundamental overhaul of the global monetary system is necessary. They advocate for reforms that would limit the ability of central banks to manipulate interest rates and money supply, urging for a more sustainable, transparent, and equitable system of money and credit. The book calls for greater fiscal responsibility, debt reduction, and the promotion of policies that encourage saving and investment rather than excessive borrowing. In conclusion, The Age of Debt Bubbles offers a comprehensive analysis of the role of debt in modern economies and its impact on global financial stability. By detailing the processes through which debt bubbles are created and burst, the book provides a critical view of the contemporary economic system. The authors argue that the current trajectory is unsustainable and that without significant reforms, the cycle of debt and financial crises will continue to shape the future of the global economy.